Let's read about transactions with affiliates from the Reference Guide to Regulatory Compliance. This has turned into Federal Reserve Board Regulation W, as we will see. The Garn Street Germain Depository Institutions Act of 1982 revamped sections of 23A and 23B of the Federal Reserve Act. These sections place restrictions on the transactions that all federally insured banks may undertake with respect to an affiliated organization. The purpose of these restrictions is to safeguard the bank's assets and deposits from losses related to unsafe or unsound activities with affiliates. The restrictions were designed to prevent a bank from risking too large an amount in affiliated enterprises and to ensure that extensions of credit to and investments in affiliates are collateralized properly. In 2000, the Gramm-Leach-Bliley Act increased the types of affiliations a bank is permitted to have. In 2003, the Federal Reserve Board issued Regulation W, Transaction Between Member Banks and Their Affiliates, to implement Sections 23A and 23B of the Federal Reserve Act. Due to its increased role in managing risks after the Gramm-Leach-Bliley Act, many of the Federal Reserve staff interpretations were incorporated into Reg W. Reg W also applies by statutory reference to state non-member banks and savings associations. Subpart 1, Reg W, Coverage. A. Affiliates, including parent companies, companies under common control by a parent company, companies under other common control, companies with interlocking directorates, which is any company in which a majority of its directors, trustees, or general partners constitute a majority of the persons holding any such office with the bank or any company that controls the bank. 5. Sponsored and advised companies, which is any company that is sponsored and advised on a contractual basis by the bank or an affiliate of the bank. 6. Investment companies, including A and B. A, any company for which the bank or a bank affiliate serves as an investment advisor. And B, any other investment fund for which the bank or a bank affiliate serves as an investment advisor, if the bank and its affiliates own or control more than 5% in the aggregate of any class of voting stock or the equity capital of the fund. 7. Depository institution subsidiaries. 8. Financial subsidiaries. This does not apply to savings association subsidiaries, which do not meet the statutory definition of financial subsidiary. Number 9, under affiliates, companies held under merchant banking or insurance company investment authority if the holding company of the bank owns or controls directly, indirectly, or through any other person 15% or more of the equity capital, unless A, the holding company does not control the company. B, the company is not considered an affiliate because no director, officer, or employee of the holding company serves as a director, trustee, or general partner of the company. Roman numeral 2, a person not affiliated with the holding company owns or controls a greater percentage of the equity capital of the company than is owned or controlled by the holding company, and no more than one officer or employee of the holding company serves as a director or trustee of the company. 3, a person who is not affiliated with the holding company owns or controls more than 50% of the voting shares of the company, and officers and employees of the holding company do not constitute a majority of trustees or directors of the company. In Roman numeral 4, the holding company owns an investment in a private equity fund that owns or controls the equity capital of the company unless the holding company owns or controls the private equity funds. 10. Under affiliates, partnerships associated with the bank or an affiliate, any partnership for which the bank or its affiliate serves as an general partner, or for which the bank causes any director, officer, or employee to serve as a general partner. 11. Subsidiaries of any of the entities listed above. 12. Any company the Federal Reserve determines by regulation or order, or the appropriate banking agency determines by order to have a relationship with the bank such that covered transaction between the bank and the company may detrimentally affect the bank. Affiliates do not include subsidiaries of the bank unless the company is a depository institution, a financial subsidiary, directly controlled by one or more affiliates of the bank, or a shareholder that controls the bank. D. An employee stock option plan for the benefit of the shareholders, partners, or employees of the bank or affiliates. and E, any other company determined to be an affiliate. Lastly, under affiliates is for savings associations, for savings associations, any company the Office of Thrift Supervision determines to present a risk to the safety and soundness of the institution, which is now going to be the OCC, not the OTS. Letter B under coverage is covered transactions. An extension of credit to the affiliate, a purchase of or an investment in a security issued by this affiliate, a purchase of an asset from the affiliate except as specifically exempted by order or regulation, the acceptance of a security issued by the affiliate as collateral for an extension of credit to any person or company, the issuance of a guarantee, acceptance, or letter of credit on behalf of the affiliate, including a confirmation of a letter of credit issued by the affiliate and a cross-affiliate netting arrangement. Low-quality assets are also covered under this section. 1 through 5. Assets classified as substandard, doubtful loss, special mention, or other transfer risk problems in a regulatory examination or in an internal review by the bank or the affiliate. And 2. Assets in a non-accrual basis status. 3. Assets on which principals or interest payments are more than 30 days past due. 4. Assets whose terms have been renegotiated or compromised due to deteriorating financial condition of the obligor. 5. Assets acquired through foreclosure, repossession, or other means in satisfaction of a debt previously contracted if the asset has not yet been reviewed in a regulatory examination. Subpart 2, requirements of Section 23A, maximum covered transactions. 1. The aggregate of covered transactions between a bank and a single affiliate other than a financial subsidiary of the bank may not exceed 10% of the capital, stock, and surplus of the bank. The aggregate of covered transactions between a bank and all affiliates may not exceed 20% of the bank's capital and surplus. 3rd, all covered transactions must be on terms and conditions that are consistent with safe and sound banking practices. And 4, for a savings association, the measure is unimpaired capital and unimpaired surplus. For a savings association. B, collateral requirements collateral requirements in credit transactions with affiliates. All credit transactions with affiliates must be secured at the time of the transaction by collateral having a market value of at least 100% of the amount of the transaction, if the collateral consists of obligations of the U.S. government or its agencies, obligations fully guaranteed by the U.S. government or its agencies, notes, drafts, bills of exchange, or bankers' acceptances eligible for purchase or rediscount by the Federal Reserve Bank. 4th, a segregated earmarked deposit account with the bank that is for the sole purpose of securing the credit transaction. B, 110% of the amount of the transaction if the collateral is an obligation of a state or a political subdivision of a state. C, 120% of the amount of the transaction if the collateral is other debt instruments including loans or receivables. D, 130% of the amount of the transaction if the collateral is stock, leases, or other types of real or personal property. So these are collateral requirements in credit transactions with affiliates. And it's like 100% or more in general. That's pretty severe. Okay. 2. The following items are not eligible to be used as collateral for credit transactions between affiliates. This is low-quality assets as we defined earlier, securities issued by any affiliates, equity securities and debt securities issued by the bank that represent the regulatory capital of the bank, tangible assets unless approved by the Federal Reserve, guarantees, letters of credit, and other similar investments, and perfection requirements. Number 3. Under requirements of Section 23A. Section 23A requires banks to maintain a security interest in collateral. The collateral must be perfected and enforced in the event of default. A bank must obtain a first priority security interest in required collateral or conduct deduct from the value of collateral the lesser of the amount of any security interest that is senior to that of the bank, or the amount of any credit secured by the collateral that is senior to that of the bank. 4. Replacement requirements. The bank must ensure that when required collateral is amortized or retired, it is replaced by additional eligible collateral equal to the percentage required at the inception of the transaction. 5. Collateral requirements do not apply to an acceptance that is already fully secured, the unused portion of an extension of credit to an affiliate, provided the bank has no legal obligation to advance additional funds until the affiliate provides the required amount of collateral. And C. The purchase of a debt security issued by an affiliate, provided the bank purchases the security from a non-affiliate in a bona fide security market transaction. C. Purchasing low-quality assets from affiliates. Number 1, general rule. A bank may not purchase a low-quality asset from an affiliate unless, pursuant to an independent credit evaluation, the bank had committed itself to the purchase before the time the asset was acquired by the affiliate. 2. Reviews of or additional credit provided under participations are not subject to the general rule if all of the following conditions apply. A. The loan was not a low-quality asset at the time the bank purchased the participation. B. The renewal is approved by the bank's board of directors to protect the bank's investment by enhancing the ultimate collection of the original indebtedness. If the originating affiliate is a depository institution, the approval may be done by an executive committee of the board or by one or more senior management officials of the bank, provided the board sets forth the standards for renewal or additional credit and the board eventually reviews renewals. C. The bank's share of the renewal or extension of credit does not exceed its proportional share of the original transaction by more than 5% unless the bank obtains prior written approval from its primary federal banking regulatory agency. D. The bank provides its primary regulatory agency with written notice of the renewal not later than 20 days after consummation. Additional savings association rules. A savings association may not make a loan to an affiliate unless the affiliate is solely engaged in activities that the Federal Reserve Board has approved for bank holding companies under the Bank Holding Company Act. Savings association rules. Number 2, a savings association may not purchase or invest in securities issued by a subsidiary except the shares of the subsidiary. Transactions with non-affiliates. General rule. Any transaction with any person must be treated as a transaction with an affiliate to the extent that the proceeds are used for the benefit of or are transferred to the affiliate. 2. An extension of credit by a bank to a non-affiliate is not treated as an extension of credit to an affiliate if the proceeds are used to purchase an asset through an affiliate of the bank and the affiliate is acting only as an agent or broker, and C. The asset is not issued, underwritten, or sold as principal by any affiliate of the bank. This does not apply to the commission, agency fee, or other compensation. Number 3, under transactions with non-affiliates. The following transactions are not subject to the limits on maximum covered transactions or the collateral requirements for covered transactions between affiliates. Riskless principal transactions, which are extensions of credit by a bank to a non-affiliate, are covered by this exemption if the proceeds are used to purchase a security through a securities affiliate of the bank and the affiliate is acting exclusively as a riskless principal in the transaction. 2. The security purchased by the non-affiliate is not issued, underwritten, or sold as principal other than as a riskless principal by an affiliate of the bank. And 3. Any riskless principal markup or other compensation received by the securities affiliate from the proceeds of the extension of credit is substantially the same or less than those for comparable transactions with non-affiliates. B. Brokerage commissions or compensation if they are substantially the same or less than those in a comparable transaction with a non-affiliated entity. And C. An extension of credit from a pre-existing line of credit by a bank to a non-affiliate if the proceeds are used to purchase a security from or through an affiliate of the bank, and 2. The extension of credit is made pursuant to and consistent with any conditions imposed in relation to a pre-existing line of credit that was not established in contemplation of the purchase of securities through an affiliate. D. Under the following transactions are not subject to the maximum limits described earlier. General purpose credit card transactions. extensions of credit to the bank to a non-affiliate via general purpose credit card when the proceeds are used to purchase goods from an affiliate. A general purpose credit card is a credit card issued by the bank that is widely accepted by merchants that are not affiliates of the bank. If less than 25% of the purchases with the card are from one or more bank affiliates, and all the affiliates of the bank would qualify for financial holding company status, and the bank has no reason to believe that 25% or more of the purchases are from an affiliate, or the bank presents information to the Federal Reserve that demonstrates that less than 25% of the total value of purchases is from affiliates. What on earth would you be purchasing with a credit card from your affiliates? I don't know. But anyways, valuation and timing principles. 1. Initial valuation. The credit transaction with an affiliate must be valued at the greater of the principal amount of the transaction amount owned by the affiliate to the bank under the transaction, or the sum of the amount provided to or on behalf of the affiliate, and any additional amount the bank could be required to provide to or on behalf of the affiliate under the terms of the transaction. Number 2, initial valuation of certain acquisitions. A credit transaction with an affiliate acquired from a non-affiliate must be valued at the sum of the total amount of consideration given by the bank and any additional amount that the bank might be required to provide to or on behalf of the affiliate under the terms of the transaction. 3. Valuation and timing principles. A bank's purchase of a debt security issued by an affiliate is not governed by these valuation rules. 4. Timing, valuation and timing principles, so part E. 4. Timing, general rule. A bank engages in credit transaction with an affiliate at the time during the day that the bank becomes legally obligated to lend to, issue a guarantee, or confirm a letter of credit for an affiliate. 2. The bank enters into a cross-affiliate netting arrangement, or the bank acquires an extension of credit or guarantees or issues a letter of credit on behalf of an affiliate. B. Credit transactions with non-affiliates that become affiliates. This is under timing. The transaction becomes a covered transaction when the non-affiliate becomes an affiliate of the bank. 2. The bank is not required to reduce the amount of the covered transaction with a non-affiliate when it becomes an affiliate, but the bank must treat the amount of any such credit as part of the aggregate amount of the bank's covered transactions for the purpose of determining compliance with the quantitative limits for future transactions. The bank must meet the collateral requirements of Regulation W promptly if the non-affiliate becomes an affiliate less than 1 year after the credit transaction. C. Credit transactions with a non-affiliate in contemplation of the non-affiliate becoming an affiliate. The bank must ensure that the aggregate amount of the covered transactions with a non-affiliate will not exceed the quantitative limits at the time the non-affiliate becomes an affiliate. And 2, the credit transaction complies with the collateral requirements of Reg W at the time the non-affiliate becomes an affiliate. F. Value and timing of asset purchases. General rule. The purchase of an asset by a bank from an affiliate must be valued initially at the total amount of consideration given for the asset. After the purchase, the asset may be depreciated in accordance with GAAP. 2. Exceptions. Purchases from affiliates and extensions of credit to affiliates must be valued using the general valuation principles, unless the purchase is of a security issued by the affiliate. B. Purchases of securities issued by affiliates are valued using the principles in Title 12 of the Code of Federal Regulations, Chapter 223.23. Transfers of securities issued by affiliates to the bank that are treated as purchases of assets must be treated as acquisitions of affiliates under that same chapter, but .31 of the Code of Federal Regulations. D. Purchases of lines of credit, revolving credit facilities, or other similar credit arrangements from affiliates must be valued initially at the total amount of consideration given by the bank for the credit, plus any additional amounts the bank might be required to advance under the terms of the credit agreement. And 3. Timing. General rule. A purchase of an asset remains a covered transaction for as long as the bank holds the asset. And B. a bank's purchase of assets from non-affiliate in contemplation of the non-affiliate becoming an affiliate of the bank becomes the covered transaction at the time the non-affiliate becomes an affiliate. The aggregate limits on covered transactions apply at the time the non-affiliate becomes an affiliate. G. Valuation and timing principles for purchases of investments and securities issued by an affiliate. Valuation. Number 1. The bank's purchase or investment in a security issued by an affiliate must be valued at the greater of the total amount of consideration paid for it or the carrying value of the security. Timing. Number 1A. 2A. General rule. The purchase of or investment in a security issued by an affiliate remains a covered transaction for as long as the bank holds the security. B. The bank's purchase of or investment in a security issued by a non-affiliate that becomes an affiliate. 1, 2, and 3. 1. A transaction becomes a covered transaction when the non-affiliate becomes an affiliate of the bank. Roman numeral 2. The bank is not required to reduce the amount of its covered transactions with a non-affiliate when it becomes an affiliate. Roman numeral 3. The bank must meet the collateral requirements of Reg W promptly if the non-affiliate becomes an affiliate less than 1 year after the transaction. Letter H. Valuation of extensions of credit secured by affiliate securities. 1. Extensions of credit to a non-affiliate secured exclusively by affiliate securities must be valued at the lesser of the total value of the extension of credit or the fair market value of the securities issued by the affiliate that are pledged as collateral, provided the bank verifies that the securities meet the market quotation standards of Reg W. Extensions of credit to an affiliate secured by affiliate securities and other collateral must be valued at the lesser of, and this is the valuation of extensions of credit secured by affiliate securities. So, must be valued at the lesser of the total value of the extension of credit less the market value, fair market value of the non-affiliate collateral, or the fair market value of securities issued by the affiliate and held as collateral if the bank verifies that the securities meet the market quotation standards of Reg W. Number 3, under valuation of extensions of credit secured by affiliate securities, is eligible affiliated mutual fund securities are not considered to be securities issued by an affiliate for valuation purposes unless the bank knows or has reason to know that the proceeds of the extension of credit will be used to purchase the eligible affiliate mutual fund securities collateral or will otherwise be used for the benefit of the affiliate. Letter I. Applicability of Section 23A to the acquisition of an affiliate that becomes an operating subsidiary of the bank after acquisition. 1. A bank's acquisition of securities issued by an affiliate is treated as a purchase of assets if, as a result, the company becomes an operating subsidiary of the bank and the company has liabilities or the bank gives cash or other consideration for the security. 2. Valuation. Initial valuation. This type of transaction must be valued initially at the greater of the sum of the consideration given by the bank for the security plus the total liabilities of the company acquired or the total value of all covered transactions acquired by the bank as a result of the security acquisition. Ongoing valuation. The value of the bank's acquisition of securities of an affiliate may be reduced after the initial transfer to reflect amortization or depreciation of the assets. Of the transferred company to the extent that such reductions are consistent with GAAP and sales of the assets of the transferred company. So let me just reread that. Ongoing valuation. The value of the bank's acquisition of securities of an affiliate may be reduced after the initial transfer to reflect amortization or depreciation of the assets of the transferred company to the extent that such reductions are consistent with GAAP and sales of the assets of the transferred company. 3. Exemptions for step transactions. A bank's acquisition of securities of an affiliate is exempt from the requirements of Reg W other than safety and soundness requirements and market term requirements if the following 4 conditions are met. A through D. A. The bank acquires the securities issued by the transferred company within 1 business day after the company becomes an affiliate of the bank. This time period may be extended up to 3 months by the bank's appropriate federal banking regulatory agency. B. The bank acquires all the securities of the company that were transferred in connection with the transaction that made the company an affiliate of the bank. C, the business and financial condition of the transferred company, including the asset quality and liabilities, does not materially change from the time the company becomes an affiliate of the bank and the time the bank acquires securities. And D, at or before the time the transferred company becomes an affiliate of the bank notifies its appropriate federal banking regulatory agency and the Federal Reserve of the bank's intent to acquire the company. Remaining in Reg W is letter J, rules applicable to financial subsidiaries of the bank. K, derivative transactions. L, quantitative limits and collateral requirements between affiliates and when those are exempt. M, cover transactions that are exempt from the quantitative limits again, but put in different words. And additional exemptions under section 23A and notification to OTS, letter O. Subpart 3 is requirements of 23B, and subpart 4 is enforcement. But under 23B, you have market term requirements, protected asset purchase, advertisement restrictions, standards for exemptions from 23B, and application of sections 23A and B to U.S. branches and agencies of foreign banks. I'm going to have to break because